Question 1. Which of the following is the primary factor that determines the payout amount for a fixed annuity during the payout phase? A. The interest rate environment at the time of the purchase. B. The accumulation phase performance. C. The gender and age of the annuitant. D. The surrender charges applied during the accumulation phase. Answer: C. The gender and age of the annuitant. Explanation: the payout amount for a fixed annuity during the payout phase is largely determined by the annuitant's age and gender. These factors help insurance companies calculate life expectancy and set the periodic payout amount. The older the annuitant, the higher the payout since the life expectancy is shorter. Gender also plays a role, with women typically receiving smaller payouts than men because they generally live longer. This is in contrast to the interest rate environment and the performance of the accumulation phase, which are more relevant to variable annuities or equity indexed annuities. Question 2. Mr. Thompson has a variable annuity with a guaranteed minimum income benefit (GMIB) rider. He begins withdrawing funds after the annuity has accumulated for 7 years. What will be the effect of the GMIB on his withdrawals? A. It ensures that Mr. Thompson will never receive less than the initial investment amount, regardless of market performance. B. It guarantees a minimum payout amount based on his initial investment, even if the value of the variable annuity has decreased due to market volatility. C. It allows Mr. Thompson to withdraw a higher percentage of his principal during the first 5 years of the payout phase. D. It eliminates the risk of market fluctuations entirely, guaranteeing fixed payouts based on market performance. Answer: B. It guarantees a minimum payout amount based on his initial investment, even if the value of the variable annuity has decreased due to market volatility. Explanation: the guaranteed minimum income benefit (GMIB) rider is a feature in some variable annuities that guarantees a minimum level of income regardless of how the investments in the annuity perform. Even if the market value of the annuity decreases, Mr. Thompson will still be entitled to a guaranteed minimum payout based on his initial investment or the guaranteed value specified in the contract. This rider does not ensure the annuitant will never receive less than their initial investment, a common misconception, but rather it guarantees a minimum level of income during the payout phase. Options C and D are incorrect because they describe features not tied to the GMIB. Question 3. Scenario-based. Mr. Johnson, a 55-year-old investor, is considering replacing his current fixed annuity with a new variable annuity. His financial advisor suggests this move, highlighting the potential for high returns based on the market performance of the new variable annuity. Mr. Johnson is concerned about the risk of market fluctuations and has a moderate risk tolerance. According to Connecticut annuity regulations, which action should Mr. Johnson take to ensure that this transaction is suitable for his situation? A. Mr. Johnson should accept the advisor's recommendation as it is based on the potential for high returns and he is of an appropriate age. B. Mr. Johnson should request a full explanation of the new annuity's risk profile, including the potential for losses, and ensure that the transaction aligns with his financial goals and risk tolerance. C. Mr. Johnson should proceed with the replacement as the new annuity provides the possibility of higher payouts due to market fluctuations. D. Mr. Johnson should sign the replacement contract immediately as Connecticut law does not require any further consideration of his risk tolerance. Answer: B. Mr. Johnson should request a full explanation of the new annuity's risk profile, including the potential for losses, and ensure that the transaction aligns with his financial goals and risk tolerance. Explanation: Connecticut's annuity regulations emphasize suitability, meaning that any recommendation or transaction must be in line with the consumer's financial situation, goals, and risk tolerance. As Mr. Johnson is 55 years old with moderate risk tolerance, a thorough understanding of the risks and benefits associated with the new variable annuity is essential. The advisor must disclose the risks, including the potential for losses, and ensure the product aligns with Mr. Johnson's long-term goals. Option A is incorrect because simply being of an appropriate age does not automatically make the recommendation suitable. Option C suggests that higher payouts alone justify the replacement, which could be misleading if the risks are not properly explained. Option D is incorrect, as Connecticut law requires agents to evaluate suitability and not proceed with the replacement without this assessment. Question 4. Which of the following statements is true regarding the tax treatment of annuities in Connecticut? A. Annuity contributions are tax deferred until withdrawals begin, but the entire withdrawal amount is taxable as ordinary income. B. Contributions to tax-qualified annuities are taxed at the time of contribution, but withdrawals are tax-free. C. The interest earned on a non-qualified annuity is taxed as capital gains when withdrawn. D. Tax-qualified annuities allow for tax-free growth on both contributions and earnings until withdrawal. Answer A. Annuity contributions are tax-deferred until withdrawals begin, but the entire withdrawal amount is taxable as ordinary income. Explanation: in Connecticut, as well as in other states, annuities are generally subject to tax-deferred growth, meaning that no taxes are owed on the earnings until the withdrawal begins. When withdrawals are made, the earnings interest are taxed as ordinary income, not capital gains, regardless of the original investment's nature. This applies to both qualified and non-qualified annuities. Option B is incorrect because tax-qualified annuities such as IRAs or 401(k) annuities have tax-deferred contributions, but withdrawals are taxed as income, not tax-free. Option C is incorrect because the earnings on non-qualified annuities are taxed as ordinary income, not capital gains. Option D is incorrect because tax-qualified annuities do not allow tax-free growth. Taxes are deferred until withdrawals. Question 5. Which of the following is a key difference between a fixed annuity and a variable annuity? A. A fixed annuity guarantees a specific rate of return, while a variable annuity allows the return to fluctuate based on market performance. B. A fixed annuity allows for changes to the payout amount during the payout phase, while a variable annuity has fixed payouts. C. Fixed annuities provide higher payout amounts than variable annuities due to guaranteed returns. D. A fixed annuity is not subject to surrender charges, whereas a variable annuity always imposes them. Answer A. A fixed annuity guarantees a specific rate of return, while a variable annuity allows the return to fluctuate based on market performance. Explanation: the key difference between a fixed and a variable annuity is the return rate. A fixed annuity provides a guaranteed interest rate for a specific period, ensuring a fixed payout amount regardless of market conditions. In contrast, a variable annuity's return is tied to the performance of the underlying investment options, such as stocks, bonds, or mutual funds, so the payout amount can fluctuate based on market performance. Option B is incorrect because fixed annuities do not change payouts during the payout phase, while variable annuities can change due to market performance. Option C is incorrect because fixed annuities typically offer lower returns compared to the potential higher returns of variable annuities, but the trade-off is risk. Option D is incorrect because both types of annuities may involve surrender charges if the annuitant withdraws funds early. Question 6. Mrs. Allen, a 60-year-old retiree, is considering purchasing an equity-indexed annuity (IRA) to supplement her retirement income. She is concerned about the potential for loss due to market fluctuations, but also desires higher returns than what a fixed annuity can offer. What key feature of the IA should Mrs. Allen understand before making a decision? A. The return on the IA is tied to a stock market index, but her principal will be protected from loss due to a floor rate. B. The IA offers guaranteed fixed returns, but does not participate in any market movements. C. The IA allows for unlimited upside potential based on stock market performance with no risk of loss. D. The return on any IA is entirely dependent on the performance of the insurance company and not on any market index. Answer A. The return on the IA is tied to a stock market index, but her principal will be protected from loss due to a floor rate. Explanation: equity-indexed annuities (IRAs) are a type of annuity where the return is linked to the performance of a stock market index like the S&P 500. They provide the potential for higher returns compared to fixed annuities while offering a level of protection from market losses due to a floor rate, often 0% or a small positive rate. This means that if the index performs poorly, the IRA's value will not decrease, thus protecting the principal. Option B is incorrect because the IA does participate in market movements and does not guarantee fixed returns. Option C is incorrect because the IA does not allow for unlimited upside. It typically has a cap or participation rate. Option D is incorrect because the return of an IA is directly tied to a market index, not the insurer's performance. Question 7. Which of the following is a feature unique to the guaranteed lifetime withdrawal benefit of the rider in an annuity contract? A. It guarantees the annuitant a minimum annual withdrawal for as long as they live, regardless of the account balance. B. It guarantees the annuitant a minimum annual payout based on their contributions, without regard to their life expectancy. C. It provides the annuitant with guaranteed withdrawals for a fixed period, such as 10 or 20 years. D. It allows the annuitant to withdraw up to 100% of the account value in the first 5 years. Answer A. It guarantees the annuitant a minimum annual withdrawal for as long as they live, regardless of the account balance. Explanation. The guaranteed lifetime withdrawal double rider guarantees that the annuitant will receive a fixed amount of income for as long as they live, even if the annuity's account balance is exhausted. The GLWB is not dependent on market performance or the account balance once withdrawals begin, providing a sense of security for individuals who need stable income throughout their retirement. Option B is incorrect because the GLWB guarantees a withdrawal amount based on the annuitant's life expectancy and the value of the annuity at the time of purchase, not just the contributions. Option C is incorrect because GLWB guarantees withdrawals for the lifetime of the annuitant, not for a fixed period. Option D is incorrect because GLWB does not provide the ability to withdraw the entire account value upfront. It focuses on lifetime withdrawals. Question 8. Which of the following is an ethical consideration for an agent when recommending the replacement of an existing annuity policy with a new one? A. The agent must prioritize the commission from the sale of the new policy over the client's financial interests. B. The agent must ensure the new annuity meets the client's long-term financial goals, including an assessment of suitability and disclosure of all fees involved. C. The agent is not required to provide the client with the benefits and risks of the new annuity if the client insists on purchasing it. D. The agent may proceed with the replacement even if the client's current annuity has no surrender charges. Answer. B. The agent must ensure the new annuity meets the client's long-term financial goals, including an assessment of suitability and disclosure of all fees involved. Explanation. Ethically, an agent must act in the best interest of the client and ensure that the replacement of an existing annuity is suitable for the client's financial goals and needs. This includes providing full disclosure of all fees, surrender charges, and any potential disadvantages of replacing the annuity. The agent must also conduct a suitability assessment to determine whether the replacement is beneficial based on the client's risk tolerance, investment objectives, and financial situation. Option A is incorrect because commissions should not take precedence over the client's needs. Option C is incorrect because agents are required to disclose all material facts even if the client insists on purchasing. Option D is incorrect because an agent should not recommend a replacement if it is not in the client's best interest, regardless of surrender charges. Question 9. Scenario-based. MS. Harris, a 40-year-old woman, is reviewing an annuity contract and is considering purchasing a product with a long-term care rider. She is primarily concerned about potential long-term care needs in the future, but is also interested in ensuring her beneficiary is taken care of. What should MS. Harris do before committing to the purchase? A. She should consult a long-term care expert to determine if this rider is appropriate for her and her beneficiaries, considering her financial situation and future healthcare needs. B. She should purchase the annuity with the long-term care rider immediately, as it will guarantee high returns and provide sufficient coverage for her future healthcare. C. She should decline the long-term care rider since it is unnecessary at her age and she can purchase separate long-term care insurance later. D. She should rely on the annuity agent's recommendation without further investigation since the agent is licensed to sell the product. Answer A. She should consult a long-term care expert to determine if this rider is appropriate for her and her beneficiaries, considering her financial situation and future healthcare needs. Explanation. Before committing to purchasing an annuity with a long-term care rider, it is important for MS. Harris to consult with a long-term care expert or financial advisor. This ensures that the rider is a good fit for her specific needs, including her financial situation and future healthcare requirements. The agent's recommendation is helpful, but MS. Harris must fully understand the benefits and limitations of the rider and whether it aligns with her overall retirement and long-term care plans. A long-term care rider on an annuity can offer additional benefits for healthcare needs, but it may not always be the best solution depending on the client's age, financial goals, and health condition. Additionally, this rider may come with additional fees or limitations that may affect MS. Harris' decision. Consulting an expert will ensure she has a clear understanding of whether this option truly benefits her in the long term and whether a separate long-term care insurance policy might be a better fit. Option B is incorrect because purchasing the product immediately without considering all the details could lead to unnecessary costs or suboptimal coverage. Option C is incorrect because declining the rider might not be the best choice if she wants to plan ahead for long-term care coverage. Option D is incorrect because relying solely on the agent's recommendation without doing further research could result in a decision that is not fully aligned with her best interests. Question 10. Mr. Stevens, age 65, is considering an immediate annuity as part of his retirement income plan. He is concerned about his potential longevity and wants to ensure he will receive a steady income for as long as he lives. What is the key feature of an immediate annuity that can address this concern? A. The income from an immediate annuity is guaranteed for the lifetime of the annuitant, providing a steady stream of income no matter how long the annuitant lives. B. The immediate annuity offers a fixed payout for 10 years and then stops, regardless of the annuitant's life expectancy. C. The immediate annuity allows the annuitant to withdraw up to 100% of the account balance at any time without penalties. D. The immediate annuity guarantees a variable income based on the stock market performance with no minimum payout amount. Answer A. The income from an immediate annuity is guaranteed for the lifetime of the annuitant, providing a steady stream of income no matter how long the annuitant lives. Explanation: an immediate annuity provides a guaranteed income stream for the annuitant, typically starting immediately after the purchase. This income is paid out for the annuitant's lifetime if chosen as a lifetime option, addressing concerns about longevity risk by ensuring that the annuitant will continue receiving income regardless of how long they live. Option B is incorrect because a fixed payout for a set period is a characteristic of a term-certain annuity, not an immediate annuity with lifetime payments. Option C is incorrect because an immediate annuity does not allow the annuitant to access 100% of the balance without penalties. It provides income according to the terms of the annuity. Option D is incorrect because an immediate annuity with variable income would be classified as a variable annuity, not a typical immediate annuity. Question 11, scenario-based. Mr. Johnson is in his early 50s and is considering purchasing an annuity that will allow him to start receiving payments in 10 years. He wants to ensure that the annuity is suitable for his retirement goals and does not want to take unnecessary risks with his investment. What type of annuity would best suit Mr. Johnson's needs? A fixed deferred annuity, which guarantees a fixed rate of return during the accumulation phase and provides predictable payments when the payout phase begins. B. A variable annuity, which allows for investment in various assets and has the potential for higher returns, but also comes with greater risk. C. An immediate annuity, which would begin payouts within 1 year, since he wants to start receiving income immediately. D. A life insurance policy with an annuity rider, which would provide both death benefits and income after 10 years. Answer A. A fixed deferred annuity, which guarantees a fixed rate of return during the accumulation phase and provides predictable payments when the payout phase begins. Explanation: a fixed deferred annuity would be the most suitable choice for Mr. Johnson as it guarantees a fixed rate of return during the accumulation phase, which is ideal for someone who wants stability and predictability in the long term. The deferred annuity would allow him to delay payouts for 10 years, which aligns with his needs. When the payout phase begins, he would receive regular, predictable payments. Option B is not ideal since a variable annuity involves market risks that may not align with Mr. Johnson's desire for stability. Option C is incorrect because an immediate annuity would begin payouts right away, which does not match Mr. Johnson's plan to start receiving payments in 10 years. Option D is incorrect because a life insurance policy with an annuity rider would typically be a more complex product, and the annuity option wouldn't necessarily offer the same guaranteed returns as a fixed deferred annuity. Question 12. Which of the following best describes the free look period in an annuity contract? A. The period during which the annuitant can cancel the contract and receive a full refund of the premium with no questions asked. B. The period during which the annuitant must pay additional fees or penalties if they decide to cancel the contract. C. The period during which the annuitant's beneficiaries must claim the death benefit if the annuitant dies. D. The period during which the annuitant can withdraw the entire account balance without incurring any surrender charges. Answer A. The period during which the annuitant can cancel the contract and receive a full refund of the premium with no questions asked. Explanation: the free look period refers to a specified time frame, usually 3 days, during which an annuitant can review the annuity contract after it is issued. If the annuitant is not satisfied with the terms, they can cancel the contract and receive a full refund of the premium paid without any penalties or surrender charges. This period allows the annuitant to reconsider their decision and ensure the product meets their needs. Option B is incorrect because the free look period allows for a full refund without penalties. Option C is incorrect because the free look period is unrelated to beneficiary claims. Option D is incorrect because the free look period does not allow for penalty-free withdrawals of the entire account balance. It focuses on cancelling the contract within the specified time frame. Question 13. Which of the following is typically true about annuity surrender charges? A. Surrender charges are imposed if the annuitant withdraws more than the allowed amount within the first few years of the contract. B. Surrender charges are imposed regardless of how much the annuitant withdraws or when. C. Surrender charges apply only to variable annuities, but not to fixed annuities. D. Surrender charges are not allowed in any state and are prohibited by law. Answer A. Surrender charges are imposed if the annuitant withdraws more than the allowed amount within the first few years of the contract. Explanation. Surrender charges are fees that may be applied if the annuitant withdraws more than a certain percentage of the annuity's value during the early years of the contract, typically within the first 5-7 years. These charges are designed to discourage early withdrawals and to protect the insurer from administrative costs associated with issuing the annuity. Option B is incorrect because surrender charges are usually tied to early withdrawals above a certain limit, not any withdrawal. Option C is incorrect because surrender charges can apply to both fixed and variable annuities. Option D is incorrect because surrender charges are allowed in most states, though their rules and limits can vary. Question 14. Which of the following is a primary advantage of purchasing a fixed annuity over a variable annuity? A. A fixed annuity offers the potential for higher returns by investing in the stock market. B. A fixed annuity provides guaranteed income payments regardless of market fluctuations. C. A fixed annuity allows the annuitant to withdraw funds without penalties. D. A fixed annuity offers flexibility in adjusting the payout amount based on the annuitant's needs. Answer B. A fixed annuity provides guaranteed income payments regardless of market fluctuations. Explanation. A fixed annuity provides a guaranteed income stream for the annuitant for a specified period or for the rest of their life, which remains unaffected by market fluctuations. This stability is its primary advantage over a variable annuity, where the payout depends on the performance of underlying investments. Option A is incorrect because fixed annuities do not offer higher returns to stock market investments. Option C is incorrect because fixed annuities may have surrender charges or restrictions on early withdrawals. Option D is incorrect because fixed annuities typically offer set, predictable payout amounts and do not allow flexible adjustments based on changing needs. Question 15. Mr. Davis is 60 years old and wants to ensure that his annuity will pay out a fixed amount each month for the rest of his life. Which annuity feature would best meet his needs? A. A single premium immediate annuity with a life-only option. B. A fixed period annuity. C. A variable annuity with a lifetime payout option. D. A fixed deferred annuity with a death benefit rider. Answer A. A single premium immediate annuity with a life-only option. Explanation. A single premium immediate annuity with a life-only option guarantees that Mr. Davis will receive a fixed amount of income for the rest of his life, regardless of how long he lives. This option is ideal for individuals seeking a predictable lifetime income stream. Option B is incorrect because a fixed period annuity only pays out for a set period, e.g. 10 years, and does not guarantee income for life. Option C is incorrect because while a variable annuity with a lifetime payout option offers potential for lifetime payments, the income amount is variable and subject to market performance. Option D is incorrect because a fixed deferred annuity with a death benefit rider is primarily focused on providing a death benefit, not a guaranteed lifetime income stream. Question 16, scenario-based. Ms. Roberts, 72 years old, is considering purchasing an annuity that will begin paying her a fixed monthly income for the rest of her life. However, she is also concerned that she may pass away soon and wants to ensure that her children will receive a portion of her annuity funds. Which option should Ms. Roberts consider to address this concern? A. A life annuity with a guaranteed period. B. A life annuity with a cost of living adjustment. C. A life annuity with a death benefit rider. D. A joint and survivor annuity. Answer A. A life annuity with a guaranteed period. Explanation. A life annuity with a guaranteed period ensures that Ms. Roberts will receive income for her lifetime, but if she passes away before the end of the guaranteed period, e.g. 10 years, the remaining payments will go to her beneficiaries, in this case her children. This provides a balance between lifetime income and a death benefit. Option B is incorrect because a cost of living adjustment only increases the payout over time but does not address the issue of passing away prematurely. Option C is incorrect because a death benefit rider typically applies to certain types of annuities, usually those tied to variable annuities or life insurance, rather than the fixed income annuity MS Roberts is seeking. Option D is incorrect because a joint and survivor annuity is designed for two people, not a single individual like MS Roberts. Question 17. Mr. Turner is considering an annuity but is unsure about the impact of inflation on his future income. What type of annuity would best protect him against inflation? A fixed annuity with a guaranteed payout. B. A fixed annuity with a cost of living adjustment, COLA. C. A variable annuity with a death benefit. D. A fixed deferred annuity with a 10-year payout period. Answer. B. A fixed annuity with a cost of living adjustment, COLA. Explanation. A fixed annuity with a cost of living adjustment, COLA, adjusts the payout amount each year to account for inflation, ensuring that the annuitant's income keeps pace with rising prices. This is especially important for individuals concerned about the purchasing power of their income over time. Option A is incorrect because a fixed annuity with a guaranteed payout provides a set income amount, which will lose purchasing power over time due to inflation. Option C is incorrect because a variable annuity with a death benefit is more focused on market performance and beneficiary protection, not inflation. Option D is incorrect because a fixed deferred annuity with a set payout period does not address inflation concerns. Question 18, scenario-based. Mr. Thompson is looking for a product that offers both investment growth potential and a guaranteed income stream in retirement. He is comfortable with some level of risk, but he does not want to risk outliving his savings. What type of annuity would be most appropriate for Mr. Thompson? A fixed immediate annuity. B. A variable annuity with a guaranteed minimum income benefit, GMIB. C. A fixed deferred annuity with a death benefit. D. A life insurance policy with an annuity rider. Answer. B. A variable annuity with a guaranteed minimum income benefit, GMIB. Explanation. A variable annuity with a guaranteed minimum income benefit, GMIB, offers the potential for investment growth through exposure to the market, stocks, bonds, etc., while providing a minimum guaranteed income stream which protects against the risk of outliving savings. The GMIB ensures that even if the market performs poorly, Mr. Thompson will still receive a guaranteed income stream. Option A is incorrect because a fixed immediate annuity provides predictable income but no investment growth potential. Option C is incorrect because a fixed deferred annuity focuses on savings accumulation and does not provide the growth potential or guaranteed income stream Mr. Thompson desires. Option D is incorrect because life insurance with an annuity rider primarily addresses death benefits and does not provide the investment growth potential Mr. Thompson is looking for. Question 19. What is typically the primary purpose of purchasing a longevity annuity? A. To provide guaranteed income payments for a specified number of years. B. To protect against the risk of outliving one's savings by starting income later in life. C. To provide income for beneficiaries after the annuitant's death. D. To ensure that the annuitant's assets will be passed to heirs without any tax consequences. Answer. B. To protect against the risk of outliving one's savings by starting income later in life. Explanation. A longevity annuity, also known as a deferred income annuity, is designed to start income payments at a later age, typically 80 or older, helping the annuitant to protect against the risk of outliving their savings. This type of annuity is often purchased with the goal of securing income in the later years of retirement when other sources of income might run out. Option A is incorrect because a longevity annuity does not provide payments for a fixed number of years, but rather for life, starting at a later age. Option C is incorrect because a longevity annuity is not focused on providing income for beneficiaries. Option D is incorrect because longevity annuities are not designed to avoid taxes or transfer assets to heirs. Question 20. Which of the following factors most directly affects the amount of income an annuitant will receive from a fixed annuity? A. The length of the annuity's surrender period. B. The annuitant's life expectancy at the time of purchase. C. The annuitant's risk tolerance. D. The performance of the underlying investment portfolio. Answer. B. The annuitant's life expectancy at the time of purchase. Explanation. The annuitant's life expectancy is a key factor in determining the amount of income they will receive from a fixed annuity, particularly if the annuity offers lifetime payments. The longer the life expectancy, the smaller the monthly payments, as the insurance company expects to make payments over a longer period. Option A is incorrect because the surrender period affects early withdrawals, not the payment amount. Option C is incorrect because a fixed annuity does not depend on the annuitant's risk tolerance as the payout is guaranteed. Option D is incorrect because the performance of the underlying investment portfolio affects variable annuities, not fixed annuities. Question 21. Mr. Martinez is considering an annuity with a lump sum payment option. Which of the following is the key characteristic of a single premium immediate annuity? A. It pays income for a set number of years, regardless of the annuitant's lifetime. B. It provides a lump sum payment after the annuitant's death. C. It starts paying income immediately after a single premium is paid. D. It allows the annuitant to withdraw the full amount at any time without penalty. Answer C. It starts paying income immediately after a single premium is paid. Explanation: a single premium immediate annuity begins paying income immediately after the lump sum is paid. It's typically used when the annuitant desires immediate income, such as during retirement. Option A is incorrect because a single premium immediate annuity pays income for the life of the annuitant, not for a fixed period. Option B is incorrect because the annuity provides income during the annuitant's lifetime, not a lump sum after death. Option D is incorrect because most annuities have restrictions on withdrawals and penalties if funds are accessed early. Question 22. What is the primary difference between an annuity with a fixed payout and one with a variable payout? A. The fixed payout annuity guarantees income, while the variable payout annuity offers no guaranteed income. B. The variable payout annuity has income that can fluctuate based on the performance of investments. C. The fixed payout annuity can only be purchased with a lump sum, whereas the variable payout annuity requires monthly payments. D. The fixed payout annuity provides benefits for beneficiaries, whereas the variable annuity does not. Answer: B. The variable payout annuity has income that can fluctuate based on the performance of investments. Explanation: a variable payout annuity's income depends on the performance of underlying investments, which means the payments can rise or fall depending on market conditions. In contrast, a fixed payout annuity provides predictable and stable payments for the annuitant's lifetime or for a set period. Option A is incorrect because variable annuities still offer guaranteed income under certain conditions, e.g. with a rider. Option C is incorrect because both types of annuities can be purchased with either a lump sum or through periodic payments. Option D is incorrect because both fixed and variable annuities can provide death benefits. Question 23, scenario-based. MS. Lewis is a 65-year-old retiree who has saved $500,000 in a retirement account. She wants to ensure that her income lasts throughout her retirement and is not worried about leaving a legacy. Which annuity option would be the most appropriate for her? A. A fixed period annuity. B. A life annuity with no guaranteed period. C. A joint and survivor annuity. D. A life annuity with a guarantee period. Answer: B. A life annuity with no guaranteed period. Explanation: a life annuity with no guaranteed period provides income for MS Lewis's lifetime, ensuring that she cannot outlive her income. This option is ideal for individuals who want a steady income for as long as they live without worrying about leaving money behind. Option A is incorrect because a fixed period annuity provides income for a set number of years and does not guarantee lifetime income. Option C is incorrect because a joint and survivor annuity is typically used by couples and provides income for 2 lives. Option D is incorrect because a guarantee period annuity would leave funds to a beneficiary if the annuitant dies within the period, which MS Lewis is not concerned about. Question 24. Which of the following is true regarding the taxation of annuities? A. The entire payout from an annuity is tax-free if purchased with pre-tax dollars. B. Only the earnings from an annuity are taxed upon withdrawal, not the principal. C. The principal portion of an annuity is taxed as ordinary income when withdrawn. D. Annuities are never subject to taxation, regardless of how they are funded. Answer: B. Only the earnings from an annuity are taxed upon withdrawal, not the principal. Explanation: when an annuity is purchased with pre-tax dollars, the principal is not taxed upon withdrawal. Only the earnings, interest, or growth are taxed as ordinary income when the annuitant begins receiving payments. Option A is incorrect because the entire payout is not tax-free. Only the principal portion is tax-deferred until withdrawn. Option C is incorrect because the principal is not taxed. Only the earnings are. Option D is incorrect because annuities are subject to taxation, especially when purchased with pre-tax funds. Question 25. Which annuity feature allows the annuitant to adjust the investment choices within the annuity, potentially increasing the value of the annuity over time. A. The death benefit rider. B. The guaranteed minimum income benefit GMIB. C. The variable investment option. D. The cost of living adjustment COLA. Correct answer. C. The variable investment option. Explanation: the variable investment option within a variable annuity allows the annuitant to adjust their investments between different funds, such as stocks and bonds, with the potential for greater growth over time. This flexibility is what makes variable annuities attractive for those seeking higher returns. Option A is incorrect because the death benefit rider only protects the beneficiaries, not the annuity's value. Option B is incorrect because the GMIB guarantees a minimum income, but does not allow for adjustments in investment choices. Option D is incorrect because COL adjusts income to keep pace with inflation, not the investment value. Question 26. Mr. Klein is purchasing an annuity and wants to ensure that his beneficiary receives payments after his death. Which of the following annuity options would best meet this requirement? A. A life-only annuity. B. A joint and survivor annuity. C. A life annuity with a guaranteed period. D. A fixed period annuity. Answer: C. A life annuity with a guaranteed period. Explanation: a life annuity with a guaranteed period ensures that if the annuitant dies before the end of the guaranteed period, the remaining payments will be made to a beneficiary. This option guarantees that the beneficiary will receive payments. Option A is incorrect because a life-only annuity ends upon the annuitant's death and provides no benefit to a beneficiary. Option B is incorrect because a joint and survivor annuity is designed for two people, not just one. Option D is incorrect because a fixed period annuity provides payments for a set number of years, regardless of whether the annuitant is alive. Question 27, scenario-based. Mrs. Chang is 70 years old and is considering an annuity that will provide her with guaranteed monthly income for the rest of her life. She wants to leave some money to her daughter if she dies early. Which annuity option would best meet her needs? A. A single premium immediate annuity with a death benefit rider. B. A life annuity with a guaranteed period. C. A joint and survivor annuity. D. A variable annuity with a living benefits rider. Answer: B. A life annuity with a guaranteed period. Explanation: a life annuity with a guaranteed period would allow Mrs. Chang to receive guaranteed income for life while ensuring that if she dies before the end of the guaranteed period, e.g. 10 years, the remaining payments will go to her daughter. This option provides both lifetime income and a death benefit. Option A is incorrect because a death benefit rider typically applies to variable annuities or life insurance, not fixed annuities. Option C is incorrect because a joint and survivor annuity provides income for two lives, not one. Option D is incorrect because a variable annuity with a living benefits rider does not provide the same certainty of lifetime income and death benefits. Question 28. Which of the following is a risk associated with purchasing a variable annuity? A. The annuitant's income is fixed and will not change. B. The annuitant's income depends on the performance of underlying investments which can fluctuate. C. The annuitant is guaranteed to make a profit regardless of market conditions. D. The annuitant can withdraw funds without any penalties or restrictions. Answer: B. The annuitant's income depends on the performance of underlying investments which can fluctuate. Explanation: the primary risk associated with a variable annuity is that the income can fluctuate based on the performance of the underlying investments, such as stocks or bonds. While this provides the potential for higher returns, it also exposes the annuitant to market risk. Option A is incorrect because the income from a variable annuity is not fixed. Option C is incorrect because variable annuities do not guarantee profit, so they are subject to market performance. Option D is incorrect because most annuities have withdrawal restrictions and penalties, especially in the early years. Question 29. A qualified annuity refers to an annuity that is purchased with funds from A. After-tax dollars. B. A non-qualified retirement account. C. A qualified retirement account, such as an IRA or 401k. D. The annuitant savings bond. Answer: C. A qualified retirement account, such as an IRA or 401k. Explanation: a qualified annuity is purchased using funds from a qualified retirement account, such as an IRA, 401k, or other tax-advantaged retirement plans. These accounts benefit from tax-deferred growth, meaning that taxes are not owed until withdrawals are made. Option A is incorrect because after-tax dollars are typically used in non-qualified annuities. Option B is incorrect because non-qualified retirement accounts, such as regular brokerage accounts, do not have the tax-deferred status of qualified accounts. Option D is incorrect because savings bonds are not typically used to purchase annuities. Question 30. Which of the following is a feature of a fixed indexed annuity? A. The annuity's value is linked to a stock market index but is not directly invested in the stock market. B. The annuity provides fixed returns regardless of the stock market performance. C. The annuity provides investment options in real estate or commodities. D. The annuity's returns are directly tied to the performance of a specific mutual fund. Answer A. The annuity's value is linked to a stock market index but is not directly invested in the stock market. Explanation. A fixed indexed annuity's value is linked to the performance of a stock market index, e.g., the S&P 500, but it is not directly invested in the stock market. This means the annuity can benefit from market gains without the risk of losses due to the market's volatility. Option B is incorrect because fixed indexed annuities are not designed to provide fixed returns. Instead, they offer returns based on index performance with a guaranteed minimum return. Option C is incorrect because fixed indexed annuities do not typically involve real estate or commodities as investment options. Option D is incorrect because the annuity is tied to an index, not a mutual fund.